and welcome to the latest Retire Well episode with me, Matthew, and as always I'm joined by Joe, and today we're going to be digesting the latest budget and what was talked about, and we're going to be focusing on what's been talked about before the budget, what was announced in the budget, and what it might mean for people going forward.
Yeah, I mean the prediction that it was going to be an absolute smorgasbord of different tax raises very much came true, and I don't think there was any massive surprises in the budget that we weren't expected. In fact, it was addressed in Prime Minister's questions prior to the budget about the amount of leaks that have been coming through into the press, and it's more than it has been previous. I mean, the biggest leak was the Office of Budget Responsibility. I think someone's just accidentally clicked a button and put it live earlier than they should have done, and then it essentially meant that everyone in the house didn't know what was happening, and everyone out the house knew what was already in the budget. So, an interesting one, and we'll break it down on sort of, yes, what's happened, but how does it actually matter, and what does it mean to you in personal finance terms?
Yeah, definitely. So starting with our usual jargon buster, you're going to take that away, Joe?
Billions of pounds is always chucked around when we're speaking about budgets, and a lot of the time you could look at it and go, what is 2 and a bit billion? So I thought it'd be good just to sort of look at the difference between what a million is and what a billion is, and I think being able to sort of just look at them, it's quite hard. So I like sometimes doing it in minutes. So a million minutes, if you were to take yourself in a time machine, go back a million minutes, you'd end up in 2023. If you were to then go back a billion minutes, you'd actually end up in Roman times in 25 AD. So there's a big difference between that million and that billion.
Definitely, and if anyone's still with us, they'll be interested in the budget.
That's one of my better facts, quite frankly. I'm quite proud of that.
That's one of your party tricks.
Yeah, but no. Moving on to sort of the main topic and chatting a little bit about pensions. I mean, the big good news story on this is what was confirmed a week prior to the budget of. There's going to be no changes to the pension tax-free cash lump sum for now. I think they may have mentioned about sort of something in the future could happen, but for now there's no changes. We've got another tax year before we have to worry about that again.
I think it's the story that always comes around every budget, and again, people were saying, should I be pressing my tax-free cash button? Should I be doing something with it? And it wasn't because of planning reasons, it was because of a fear of missing out. As we've talked about in our previous episode, focusing on what might have been in the budget, we say it's very important to plan for the long term and not to react. So the fact that there was no changes to tax relief on the way in or tax-free cash on the way out is good for pensions and the stability of pensions. And then there's been a minor tweak in relation to salary sacrifice, which has been announced to come in from April 29.
Yeah, I mean, I think the tax relief going in is a good thing. I think that would have overcomplicated a lot of things, even if it did raise a lot of money. The salary sacrifice is a strange one. They've essentially limited at the moment. You could salary sacrifice all of your annual allowance into your pension. So potentially 60,000 if you're a high earner. You can't sacrifice below minimum wage, so that's one of the limitations. But they've essentially put a limit of 2,000 a year that you can sacrifice into your pension through salary sacrifice, which it's not a great deal. And that limit is before you start paying national insurance, and the national insurance that you will pay will depend on whether you're a basic rate taxpayer or a higher rate taxpayer. So basic rate taxpayers would pay national insurance at 8%, higher rates would pay it at 2% because they've passed that higher threshold of national insurance before it reduces. I think it's probably more likely going to affect higher earners, because we a lot of the time speak with clients about using salary sacrifice to get below some of those thresholds, to get below 100,000, to get below 60,000 for the child benefit. So most likely it's not going to be sort of that big of a tax hit for the employee, but it might actually be the employers that are hit a little bit more. Matthew, do you want to run through that?
Yeah, the extra NI there could be a 15% hit for most employers. So again, in the past, salary sacrifice seemed like a good way for the employee to pay less tax, getting below a threshold, but equally the employer could say, oh well, if there's an NI saving, we could reward that and pay that also into the pension, or actually we offer salary sacrifice because of that saving. So I do think it's a strange one, especially when We want more and more people to be focusing on pensions, to save for their own financial freedom, and it sort of seems to go against that long-term message from the government. One thing I'm going to be really interested on in the detail when this is announced is, what is, well, I know what salary sacrifice is, but how do they define salary sacrifice? Because it might be that one employer has a more generous standard pension arrangement than someone else. So actually, if those two employees, work for different companies and have different pension arrangements, and they both wanted to salary sacrifice, how would they be impacted? And it might be that people are now more focused on negotiating a standard, better pension contribution rather than salary sacrificing. So we'll see how that comes into.
Yeah, I think the big one, as you said, is that employer NI. I mean, for someone that's earning 100,000 and trying to get below, if you were to sacrifice £10,000 of your salary, you'd only be paying an extra £160 a year, but your employer would be paying an extra £1,200 a year. Yeah. And if I was an employer, I'd just go, I don't particularly want to necessarily do that and limit benefits or look at benefits in another way. But moving on from pension, the state pension. Still in pensions, we're just moving on from one type of pension to another. The state pension's increasing in line with earnings this time, so we've got the triple lock of earnings, inflation, or 2.5%. Earnings have been 4.8%, outperformed the other two, which now actually brings the new state pension up to just under the personal allowance. I think it's 12,547 and some change, which obviously you're very much knocking on the door of paying tax on the state pension, and the government have addressed that. They haven't said how they're going to solve it yet, but from the next budget and the next tax year, 2027, it's almost certain, if the triple lock stays, that the state pension is going to go above that threshold. And they've essentially said that anyone that only has the state pension and no other income, they're not going to have to go through simple assessment to pay tax. Whether that's, they just say, state pension, if you're receiving it, it's just untaxable, or there's another system where they start to pay it net as opposed to gross. That's one for them to think about, not necessarily myself.
Yeah, I think it's always been, George Osborne announced that the state pension will be paid gross, and they didn't think about a scenario when allowances will be frozen for this long to then get to the point where the state pension was going to go above it. We've had some clients in the last few years where they've been impacted by this, and by the letter of the law, they then have to do a self-assessment tax return and declare the £100 tax in the year. Sensibly, the Chancellor said they're going to come up with a simple way to avoid this. We don't know what that looks like. Maybe it is almost an even simpler tax return. There's just this is what my pension was and this is the payment. Or maybe they've got a way that they're going to do it mechanically. As you say, if they made that not paid gross and put it under the PAYE system, then it would sort itself out. So that might be one of their solutions.
Yeah, I don't think anything's ever really simple with HMRC.
Well, pension simplification didn't sound that simple in the end. So I think they need to be careful when they call things simple.
Yeah, just before we actually move on from pensions, just another point on that salary sacrifice limit. It doesn't come in till April 2029. So there's a big lead time into that, where if you are a high earner, you can look at contributing more without paying it, and equally that's pretty close. In fact, it might be an election year that'll come into it. Could something like this change as a pullback to try and gain the electorate back? I mean, we'll see what position they're in when they get there. But it's interesting that quite a lot of these things have been pushed on a couple of years as opposed to being implemented in April 2026.
Definitely, and when we think about the personal allowance and the income tax bands being frozen till 2030 and 2031 tax year, that's going to the next sort of government essentially. So you're right, usually traditional politics says, you have hard taxation and the unpopular things early on, and then you let the purse strings go and you try and make people happier to be re-elected. Again, you can't see that happening on the current regime and the current sort of deficit and fiscal rules. But it'll be interesting to see how those play out. For me, we talked about it in the episode we did focusing on the budget, and the frozen allowances and frozen tax thresholds is the real stealth tax, the real painful one that affects people over time with inflation and income going up. But we've talked to a few people, talked to a colleague recently who said, they can't remember a time when these allowances did go up. So actually, in a way, it's a no-brainer for the government to get more tax revenue there. But, if we had to put money on it now, would we expect the tax rates and the thresholds will change after that point, or is it just that almost indefinite stealth tax?
Yeah, I mean, slightly separately, the national living wage has increased to £12.71, which on a 40-hour working week is 26,500 roughly.
Yeah.
If your national living wage is half of what the high rate taxpayer is, I'm not sure how long that can be sustainable. If it continues going up, because it is that stealth tax. More and more people are getting pushed into that higher rate.
Definitely, and the big announcement on taxation going up, obviously they kept income tax the same, they kept VAT the same, and they kept NI the same, so they could say we've honoured our manifesto pledges, but there has been an increase in the taxation to dividend taxation, savings income and rental income. And I think rental income is probably the most interesting one for our clients, where there's an extra 2% gone on to those bands. So that, that makes things, especially as a landlord, that makes it less attractive to, have that rental income coming through. Having the income bands there of 22%, 42% or 47% does start to feel like you're being penalised as the landlord.
Yeah, and something key on that one, the dividend increase, so the 2% on dividends, I believe comes in from April 2026. The increase to savings and the increase to property comes in April 2027. And the dividend 2% increase is only basic rate and higher rate. The savings and property is basic, high rate and additional rate, as you said there. I mean, I actually think the savings one is maybe one when you look at it and you go, oh, initially it probably won't affect that many of our clients because cash holdings, you want to just hold what you need in the short term and the rest of it would be invested. What I think could get a bit tricky on this and something where you have to explore a bit further is when you're looking at stuff like investment bonds, because as we know, they when you have a capital event and a surrender, a chargeable gain, then that's taxed at income tax rates and savings income tax rates as opposed to capital gains. So that might cause a little bit of problems, particularly on an onshore bond where you pay 20% tax within the fund, and then if you're a basic rate taxpayer, you pay a notional tax, but you don't really pay it. So adding 2% onto that, it goes, what do you do then? Do you have to start adding the 2% within the bond? Again, is there a simple assessment for that 2%? Yeah. It's just a funny one, and it's where the devil is in the details, and we'll find out exactly how this is going to progress over the next few weeks and months.
Yeah, definitely, and even on the savings income element of having cash in the bank, again. If people are doing the right things from a financial planning point of view and are using things like ISAs to shelter funds from the tax, again, maybe they're not impacted by these changes. But I think, there could be someone who said, cash has built up over time, or someone's got older and spending less and the cash buffer has increased, and they could quite easily be hitting these rates now or hitting these tax thresholds without realising. I think certainly over the last few years we've seen allowances squeeze, tax rates go up, so it's that element of going, you have to make sure you're doing the right thing every year. And we know, ISAs, it was probably the worst kept secret in the sense that there was going to be a change to an ISA. The actual end result with £12,000 being available to go into a cash ISA, and then £8,000 to be only available and allocated to the stocks and shares ISA. For us, you might disagree, but I think it makes very little impact because, in the past when interest rates were so low, cash ISAs were almost a bit of a con and weren't really sheltering people from taxation. Yes, if someone wants to hold, £20,000 in cash, an ISA is a perfect way to do it. But statistically, and Rachel Reeves mentioned it in her speech, you would get more returns over the long term by investing in stocks and shares ISA, and only keeping in cash the day-to-day savings and the emergency buffer.
Yeah, I mean, I think they're coming from it from the right place, as you said, in getting more people involved, investing and investing it, the cash as opposed to leaving it. It comes to that sort of carrot or the stick approach, like which one do you do? Yeah. I, to be honest, see most people going, if they were putting 20,000 into a cash ISA, they're not immediately going to go, oh, well, something that I don't know anything about, I'm just going to put £8,000 in there and worry about it. They're just going to go, well, 12,000 will have to do, we'll just put that into a cash ISA. I think along with this, they'll need to invest a good amount of money into general education, access to advice, and maybe something we've spoke about it previously. There's a review going on in financial advice at the moment to look at simplified advice and how providers can provide advice over just general guidance. So maybe something like that can actually help people get invested. But I think it's not something that can be fixed by just moving allowance. It needs to be a little bit more of a mindset shift in how stuff works.
I think it's one of our biggest bugbears that financial education is so poor and low in the UK. And often we're talking to people about the pensions and they're going, it's a foreign language, or I'm only really looking at it now as I'm getting older and it's getting a bit more meaningful. I've actually had my head in the sand because I've ignored it going forward. And I think that's really the issue that they want to resolve. Yes, encouraging younger people to invest, which is the mantra behind it, is brilliant. But if that doesn't come hand in hand with helping people to understand the risks and the benefits, then, as you say, it's almost like, why would I want to?
Yeah.
I also saw something that was quite funny on Twitter or X, which was someone saying, "Oh, that's fine. I'll just put £20,000 into a stocks and shares ISA, and then I'll transfer it straight back into a cash ISA." Again, it's those logistic bits that they'll definitely won't make that allowed. But how will they do it and how will it work going forward? That's the detail that we want to see.
Yeah, I mean, I think maybe the more sneaky one of that would be to use your 12,000 in a cash ISA, put 8,000 in a stocks and shares ISA, but then instead of investing that in stocks and shares, you could invest it in something like a money market fund, which is essentially like cash. And again, how do you monitor that? How do you stop people doing that? I mean, the vast majority of people won't know to do that, and the people that the target in here to get to invest won't think, oh, we'll go to a money market fund. But there's ways to get around it if you did know. And just, I'm not sure if you did mention on this, there's essentially a carve out for the over 65s, where if you're over 65, you still have the £20,000 and you're not affected.
And also, existing ISAs are, kept in their current form, so there's no impacts to those. But yeah, I think it'll be interesting going forward. The only thing in my sceptical brain at this point goes, Jeremy Hunt stood up and announced a British ISA. That was never implemented. Again, that idea was to give someone an extra £5,000 to only invest in UK companies. As soon as that was announced, the first thing I thought was, well, if something like 63% of earnings in the FTSE 100 is overseas, what are you really trying to achieve and how are you going to get it? So I think that's the bit that you highlight there, that it's really going to be interesting to see the mechanics, the mechanisms, and hopefully they don't make it unnecessarily complicated, because the current ISA system of going, you can have cash in an ISA or stocks and shares in an ISA, both are tax efficient and you can move between the two, is quite a simple thing that people have started to understand over the years and have got on board with. If it now becomes too complicated, that would be a real step backwards, I think.
Yeah, I mean, speaking about new ISA accounts, this one actually wasn't mentioned in the Chancellor's speech, but has come sort of a little bit after in the documents that you can read through. They're putting in place a consultation on lifetime ISAs, so what most people would use to purchase their first home, and this essentially saying we're going to look to discontinue them and launch a new product for first-time buyers. Again, it's a little bit of a strange one. I don't think anyone's been too worried about it. The only thing that I can really think of that might have sort of prompted this is there's currently a little bit of an issue with if you put money into a LISA, and then decide that you don't want to buy a home. If you then take it out, you're essentially penalised. You're not levelled off because, I mean, if you say you put 2,000 into a lifetime ISA, you get your 25% addition in there, brings you up to 2,500, and then if you withdraw it, there's a 25% penalty. So once you take that 25% off, you only end up with 1,875, a 6.25% tax essentially for withdrawing.
And I think Martin Lewis was also making a big noise about the sort of maximum purchase price of the property as well, maybe not being high enough for those in the south of London. So he'd been saying, "Oh, can we raise that?" Now they're going to, reform that, maybe come up with a new product. And I think again, crucially, the Help to Buy ISA existed before the Lifetime ISA. They said, "Oh, we'll stop that, we'll introduce this." And now they're going to say, "Oh no, we'll stop this and introduce this." So I think crucially, they need to have the implementation that you can move a Help to Buy ISA and a Lifetime ISA into the new product, whatever that looks like. Again, keeping the simplicity, easy to understand. And I recently had a property transaction which was actually held up from pretty much a month because a buyer had a Help to Buy, was trying to apply for the bonus. Bank and solicitor didn't really know what they were doing. Turned out they weren't even eligible for the bonus, and that held everything up. So the bit that worries me about all of this is undue complication. So hopefully with the review, whatever the new product looks like can have a way for those other previous products to transition across to the rules.
And hopefully it'll be in place for a long time, because it wasn't that long ago that we moved from a Help to Buy ISA to a lifetime ISA as the status quo.
I think there the biggest problem is the governments of the day want to have their name on the product. They almost want to be we've supported people with this, a bit like the Boris bike. It might not have been Boris's idea, but it was his name sort of stuck on the side of it. And I think that's the bit going forward that you go, oh, well, does Labour want to say, well, it's not the lifetime ISA that came from the Conservatives, it's actually the blah, 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 blah. So I think that's the crucial bit where I think personally I would like to see party politics coming out of these things a bit more and actually just have longevity of a pension for life, an ISA for life, a product that is going to be around for planning rather than political gain.
Yeah, exactly. I suppose next on the agenda for the budget, we've got the mansion tax. I mean, there was rumoured to be sort of a full wealth tax. I think they've stopped short of that and been pretty restrictive to this. I mean, this mansion tax won't affect the vast majority of the population. It starts at £2 million, and to give it its proper name, it's the high value council tax surcharge for short. And essentially, if your house is worth more than £2 million, the starting rate will be an additional surcharge of £2,500 on top of your usual council tax, and it goes all the way up to £5 million plus. In that point, then you have £7,500 surcharge, and the Chancellor essentially explained it. And there's some places in the UK where you'll have a pretty small house and you will be paying more than maybe some of the large properties down in London, which is much more. But I mean, that then comes to what you're paying council tax for. I think we said on a previous podcast, both people get their bins taken each week. Therefore, should they be paying the same rate?
Yeah, I think her example was the sort of Darlington council tax, which isn't that far away from us. And should that be more than someone in London? Again, ahead of the budget, I've spoke to a few clients and a few people who were worried and were focusing on this to say, I might have moved house, I might have downsized, or I might have had a property value that's gone up significantly over time. Suddenly to be penalised might have seemed to be unfair. But I think the value that they've pitched this at is probably high enough that the average person says, fair enough, that is a particular house, and yes, a mansion, the person who's got a mansion, can they accommodate that charge? It's not a high percentage of the value. So, yeah.
I think it's low enough as well where it shouldn't affect property prices. I mean, that would be an interesting one. People start to sell, therefore it's valued lower, therefore you don't pay the tax.
Yeah, but I did see one that was an element of saying, if it was a property in London and you were thinking about selling it and you were on that cusp and you were also being penalised by the extra tax on rent, now who's going to buy that from you? So I think that's a valid point. But again, I think that's quite a small.
Yeah, I mean, considering what was rumoured, I think this is much more palatable than the potential changes to stamp duty, where it would be on the seller to pay, which would have really restricted movements in the property market. But yeah, I feel like we've run through quite a lot of bad news so far, so I thought we'd break it up a little bit and look at inheritance tax. I mean, I'll start off, actually, it's not great news. The nil rate band and the residency nil rate band, again, they've been frozen with income tax, so that's the essentially 325 and 175 between a couple, essentially that £1 million that if you're passing it down to children that you can have. The good news, which I was going to say, is with regards to business relief and agricultural relief. So in the last budget, they essentially limited the amount of relief that you can get up to £1 million at 100%, and then after that it's at 50% relief compared to usual inheritance tax. The issue that they created was they made that not transferable, so it actually meant that people that maybe had farms or businesses, they could get around it, but they'd have to go through a bit more of a complex trust structure, which is obviously costly, a little bit more stressful. The understanding of the client might not be there, so they've essentially now said, in the same way your nil rate band and residency nil rate band can be transferred, this additional £1 million business relief can also be transferred between spouses.
Definitely, and I think thinking about inheritance tax in general, there was a view that they could have introduced a lifetime gifting allowance, which would be saying, whatever that allowance was, it might be £1 million, it might be £500,000, that could have been the amount that could be passed on in someone's lifetime, and anything above that could have been taxed at an immediate tax charge. So we talked to some solicitors who were actively putting trust in place and having funds to be outside of someone's estate, starting that process as soon as possible in case that came in. Because that hasn't come in, it's left things very much as they are, but we know that the biggest impact on that recently has been the change for pensions to fall into people's estates from 2027. So we've already seen a lot more focus from individuals on IHT planning and thinking about life insurance, trust, gifts. So I think the fact that that hasn't changed again is quite useful for people who are planning and can be building going forward. And we still have that 7-year clock. There was a rumour that might have increased, to 10 years. So again, the fact that there hasn't been another change on that space is probably quite powerful.
Yeah, I mean, maybe this is me being overly optimistic, but since we've had those two big tax increase in budgets over the next couple of years, maybe it won't be as on the table next time round, but equally I know in 12 months' time we'll still be talking about the same sort of things that might come in.
Yeah, definitely. And even as we said before, because so much of this isn't being implemented straight away, it's still going to be talked about this time next year, if not a year after. And actually, the devil's in the detail, as we've said. One thing that we noticed from, it wasn't in the speech at all, but it was there in the notes, was that investments into VCTs, venture capital trusts, the tax relief's coming down from 30% to 20% from April 26. Again, it seems like a funny one when that is investment in small companies in the UK, sort of startup businesses, and the tax relief is to offset the extra risk taken. When they're saying on one side they want people to invest in the UK to then reduce the incentive from the tax relief, does seem counterintuitive. But I did see one person say, well, maybe it's almost to try and create that scarcity of almost getting more people to go into it now before a relief drops, and you're trying to get an injection of capital, perhaps.
Yeah, I mean, I think this one comes in 2026, as you said, so there's only a real short period of time to do that. I mean, the VCT allowance at the moment is 200,000 that you can put in and get tax relief on, so max tax relief comes down from 60,000 to 40,000. Yeah. For a lot of people, 40,000 will probably be enough tax relief.
True.
But again, if you're weighing it up and planning on doing it, 10% reduction doesn't feel great. I think what would be interesting is to see if this sort of pushes a little bit more of a shift into EIS, so Enterprise Investment Scheme investments, which have the 30% relief still there, that's not been affected, and they also have the added benefit of if you do make any capital losses, which can sometimes be quite common in smaller companies, you can actually offset those losses against income tax. I think a lot of the time they're a little bit harder to access than a standard VCT, but it'd just be interesting to see how maybe that gets pushed over.
Yeah, definitely. And I think when we talk to clients about VCTs, it really is those high earners, the sophisticated clients who can warrant the investments, perhaps because the tax relief offsets some of the risk. With that tax relief coming down, the riskiness stays the same. So again, it can make it slightly less palatable. So definitely an interesting one to look at going forward. And as I said, it's that bit where you go, I'm not quite sure where it's come from their overall goals, aspirations, and is it just a bit where they think, oh well, we can get a bit more tax there, perhaps?
Yeah, I mean, sticking with shares, this is one that was signposted, and I can definitely see why they've done it. And it's essentially the stamp duty reserve tax, which is usually charged when you transfer shares on the London Stock Exchange or in the UK at 0.5% essentially. So it's only a very small amount, but they're essentially saying that they're reducing that down. They're giving essentially a holiday on that. For the first 3 years of listing, I should say, on the London Stock Exchange. And they've essentially said that, look, it's really important, those sort of formative years when you've just listed, to get an increase in the stock price, to get more investors going in. And that'll be important for the long-term business health. But then I also think this has been brought in response to a lot of maybe UK domiciled businesses that have actually gone, don't really like the London Stock Exchange, we're going to go list elsewhere, potentially in the US. Yeah. I'm not sure, again, how much this will actually change it. It's only a very small amount, but I suppose if you're a big institutional investor, 0.5% can be a lot.
Definitely. I think some of the focus on the FTSE has been to do with reporting requirements and other things. So again, whether this change makes it enough to make that more attractive, we'll wait and see. But as you say, it's certainly not a negative. and it'll be interesting to see, does it have a knock-on effect of listings there. Another change that we've seen, which again, it's trying to understand why they've done it, is the tax on electric vehicles and the sort of tax for the pence per miles of 3 pence for an electric vehicle and 1.5 pence for a plug-in hybrid. Again, where is the mixed message? Well, they want to increase electric cars, and they want to have try and hit things like the net zero targets. So a taxation increase in that seems a bit counterintuitive. But equally, is it just trying to replace the tax that they were getting from petrol as the usage starts to drop from petrol and diesel? Are they squeezing the tax elsewhere?
I mean, I think the fuel duty is why they're doing this, because they're losing out on massive amounts of revenue if we do actually push through to get to that 100% new electric car by, I think it's 2030. Yeah. But I mean, even in the same budget, there was so much contradiction on electric vehicles, because at the same time they're increasing a tax on the electric vehicles, they're rolling out grants to push charges out, make them more sort of expansive and accessible. They've increased the actual supplement where you pay a higher rate of tax on an electric car to 50,000 as opposed to the standard luxury car tax. So it's a funny one.
With all of these things, it's how they're going to actually implement them and what's going to look like. Again, we were talking to some accountants yesterday where it's a case of, well, are we going to have to submit how many miles we've done? Someone joked, if I take my car abroad, do I have to pay it for that bit? How do I prove those miles were done in France rather than the UK? And equally, the logical tests where you think about that might be something like an MOT, but a new car doesn't have an MOT for the first few years. So it's trying to see where the detail comes from and how that tax will actually be taken going forward, which is going to be the interesting one.
Yeah, and just to sort of wrap up another last couple of points before we look at a bit of a summary on the budget and maybe what we think on it. I mean, voluntary national insurance contributions for people that are living abroad, they've been scrapped, so you can't access the state pension and build up your state pension entitlement while you're not working in the UK.
Yeah.
I think that's sensible, and they've also essentially said you need to be working in the UK for at least 10 years before you can access the state pension.
Yeah.
I mean, the increase in voluntary NI contributions is supposed to be if you're out of work or something like that, but still want it. And I mean, it's pretty good value, the UK state pension, which is maybe another issue for down the road on how that's continued to be funded. And then the other one I wanted to mention is they've essentially scrapped the two-child benefit cap, which was brought in under the Tories. They initially brought it in because they were saying, we don't want people just having more children to access benefits. But I mean, Rachel Reeves said essentially they've not really seen a change in the number of children that are having, so it's not actually done what they want, so they've took that back off the table.
Yeah, and that was focused on the sort of universal credit, and I think, again, that was the message that Rachel Reeves was trying to portray in terms of we want to still have the welfare there, and it's the taxation that was maybe the quiet bit in there, but that was almost trying to balance the books.
Okay, so I think that's a pretty good place to end there. If you do have any questions with regards to the budget, I'm aware we've only covered a small portion of what was actually covered. Leave a question down in the comments, and we'll look to answer that in our next FAQs episode, which isn't too far away. If you're on YouTube, please like and subscribe and share with friends. If you're on Spotify, please leave a rating. And we look forward to seeing you again next Tuesday for another episode.